The Bank of England moved to stabilize turbulent British markets Wednesday, vowing to buy long-dated government bonds in a bid to bring down borrowing costs. The announcement coming as several UK pension funds were forced to hurriedly sell off bonds to avoid a liquidity crunch. Rising borrowing costs have also hit mortgages and other forms of credit. The market turmoil, a direct result of new government plans to cut taxes and increase borrowing. David Blanchflower is a professor at Dartmouth College and a former member of the Bank of England's Monetary Policy Committee. David, welcome to the show. What has this intervention by the Bank of England essentially prevented?
Well, it actually looks like it may well have presented the insolvency of various pension funds. So this step in by the bank was kind of crucial. But this is incredible instability brought on. It's a huge self-inflicted wound brought on by a budget imposed on Friday that was received like a complete lead balloon. And on top of that, there's all the Brexit impact things. So basically what it did was it caused markets to melt down. The exchange rate collapsed. What we're seeing is the bond market collapsed. But of course, now what all of this leads to is essentially you're going to see a housing market collapse because interest rates have got to rise. People can't get mortgages and the price of those mortgages is going up. So this looks like the UK's in great turmoil, headed into recession. This looks like an utterly incompetent economic policy by a prime minister who's been in place 3 weeks.
David, you're already answering my second question. I was going to ask, is the worst over? But it sounds like what was done by the Bank of England only solves an immediate problem of these insolvencies.
Well, they're going to run, yes, exactly. They're going to run auctions every day, and they're going to try and keep a track of that. And they've talked about perhaps doing something by the end of November. And the Bank of England talked about, we'll do something at our next meeting early in November. Well, I wouldn't believe a word of that. We're in crises such that markets are moving by the hour. There's going to be more interventions necessary. The question is, where are we going from here? I suspect we're going to have to see major action by the end of this week, and we might have to see it by tomorrow. So this whole series of questions, what will you do?
In other words, the Bank of England alone won't be able to answer these problems that we're seeing right now.
Well, I think that's right. And I think what's very telling is the IMF produced a statement yesterday saying this has got to be turned around. This is an inappropriate set of measures. This will raise inequality. So the very fact that the IMF comes out and says that, can you imagine over the last 30 years, the IMF would come out and say something about economic policy in France, in Germany, but in the UK? So this is really, and it's called for basically withdrawal of these measures. And we've no real clue where it's gone. But this is not going away quickly. It's not going to be solved by waiting until the end of November. I think we have many
David,
moves in the next few days.
Very briefly, have you ever seen this kind of disagreement between the Bank of England and the government of the UK? Very briefly, if you can.
No, not at all. And what we've seen is actually the Treasury has kind of been telling the central bank governor what to do. And the statements read as if the Treasury has written it. But at some point, the Monetary Policy Committee is going to get in there and say, hang on, folks, we need to do something. So the IMF said that the Bank of England and the Treasury are in contradiction with each other. And that's not workable. This is going to have to change. This is disastrous.
All right, we'll have to leave it there. David Blanchflower, he's professor at Dartmouth College and former member of the Bank of England. Thank you so much.
Of course. Thank you.
Let's go over now to our financial correspondent in New York, Jens Korda. You heard perhaps what David just said there, Jens, but it's not just in England that this shock is being felt, also in New York. What can you tell us?
Yeah, I mean, in general, for the moment at least, it does seem to be mostly a British problem, but that could definitely change. I mean, for once, the UK is the sixth biggest economy on the planet. The pound is also part of the reserve currency, so that does have an impact. And then we shouldn't forget, markets are very jumpy in general anyhow. I mean, we see the biggest crisis probably on bond markets globally in about 30 years or so. And when we talk markets, we talk psychology. And if something like that what happens in England right now is seen with other market participants, so that could cause certain effects. Larry Summers, by the way, the former head of the Treasury, is saying that what happens in England could actually cause a global crisis. Also, the current head of the Treasury, Janet Yellen, is saying they're monitoring the situation. So clearly the UK is not isolated with its problems at the moment.
Jens Korda in New York, thank you.
Plans by the UK government for huge tax cuts financed by borrowing have drawn strong international criticism. The International Monetary Fund issued a rare warning to a major world economy, saying the tax cuts may fuel inflation and are likely to increase economic inequality. Plans have already triggered volatility on the markets, forcing the Bank of England to announce today that it will buy as much government debt as needed to restore order. The government plan announced on Friday for deep cuts and deregulation are intended to revive a stagnant economy. Instead, they've triggered an economic crisis and seen support for the opposition surging. Here's the head of the opposition Labour Party.
They've lost control of the economy. Now, you know, we all understand when there are international issues, crises that cause fluctuations in the market, but that isn't this case. This is a situation where the government has self-inflicted harm on our economy, and people looking at their mortgages, looking at their prices this morning will be worried sick, I think, and I wouldn't be surprised if they're not a little bit angry that the government has lost control of the economy, a self-inflicted wound, and they're now picking up the bill.
Let's take a closer look at this with Phillip Inman. He's the economics editor of the UK's Observer newspaper and an economics writer for The Guardian. Welcome to DW. Has the UK's new government lost control of the economy?
Well, it's made some really significant errors. It's come into office, it's just taken over from the previous Boris Johnson regime, and out of the blue announced a huge amount of tax cuts, all of which are being done with borrowed money. And that's just going to add to the debt pile that the government already has, and that's going to spook the markets, because, you know, adding to your debts with something that isn't going to actually generate growth, which I think is most economists' point of view, is a recipe for disaster.
And how's this affecting households and businesses?
Well, households are now going to see their mortgages rise. I mean, they're already seeing their mortgages rise. And that's a problem, because obviously we are a property market economy, have been for some time. We do a bit of manufacturing on top, a few services, particularly financial services, but an awful lot of the economy is driven by what goes on in the property market. And that's already started to increase. So I think one of the analogies that people have used is that Britain is now putting its foot on the accelerator to try and generate growth with tax cuts, and that has just forced the Bank of England to put its foot on the brake. And you know, when you drive a car with the foot on the accelerator and the brake, you're probably going to break the engine.
OK. But the government says there's no need to change course. The UK's economic fundamentals are sound, they say, and the Bank of England is taking action to calm the situation. We'll hear from the number 2 at the Treasury, Andrew Griffith, and then come back to you.
We've got a very strong balance sheet. The UK has the second lowest debt to GDP ratio in the G7. The bank, as I say, has taken the timely action that it does. It's its job to regulate financial markets. And then what the government's got to do is to provide people with that confidence. So really big interventions to help every single household with the cost of energy. If we hadn't done that, Ed, just think about what the implications would be in terms of people's confidence and their cost of living this winter.
So, Phillip Inman, the government's due to flesh out the details of their plan in November. Just explain to us what happens then and why they're waiting so long.
Well, they're waiting so long because they haven't really worked out what they're going to do. They have a plan to try and generate more growth with even more tax cuts. And they now are all at sea about how to do that, because they realise that the rest of the financial community, economists, analysts, global bankers are all saying, well, actually, we're quite sceptical that this is going to work. So they have to finesse it in some way to convince them. They also we have a body in the UK called the Office for Budget Responsibility. That's been given the instruction since 2010 of sort of adjudicating on every budget. They have to come in and they will say that actually this plan isn't going to work. They've already said that in effect. And the government is now very wary of a budget that is just going to add to even more criticism.
One of the big headlines today is that the International Monetary Fund has added to these criticisms, saying that those plans would increase inequality and worsen inflation, and that Downing Street should rethink them. This sounds like quite a severe telling off for a G7 country. But why is a little local economic difficulty, if I can put it that way, in the UK? Why is that even on the IMF's radar?
Well, the IMF has been criticising most European countries without naming them for the bailouts that they've been pushing through over the last 6 months. France, Germany, the IMF doesn't like anything that they've been doing because they think they're too act like a blunderbuss. They're spraying money around on the rich and the poor to try and get through this energy crisis. And the UK is no different. What the UK has done that has really excited the IMF, really got them angry, is because we've added on top of that. So we've not just had an emergency energy price cap, which is costing 150 billion. We've added on top tax cuts, which will be recurring, which will go on forever. So that's what's really spooked them. The UK is also part of a reserve currencies. So the euro is a reserve currency, the dollar, the yen, and sterling is as well. So now we're one of the reserve currencies of this world that are messing about, that are suddenly causing chaos. And the IMF thinks that this is a moment in history when the last thing they need is a country to start causing that kind of unnecessary chaos.
And so just a brief word then about government thinking, because with the country facing a recession, rising inflation and a post-COVID economic hangover, what is this new government hoping to achieve by these tax-cutting measures?
Well, they have a theory. The theory is that it's like a sort of Ronald Reagan kind of, you go and borrow loads of money and give it to the rich and entrepreneurs in tax cuts, and they will then invest the money. They will build factories. They will, invent things. They will get out of bed earlier in the morning because they can make more money. And they will then generate the kind of tax returns you need in the future as a country. That will mean that Britain goes from a growth rate of about 1.5% a year to, they think, 2.5% a year. That's going to happen over the next 3 to 4 years, they think. Their problem is that they've held this theory for many decades. They've now had the chance to implement it, but they're doing it right at the point when we have high inflation. So actually, all they're doing is stoking even more inflation. But they can't help themselves. This is their theory. This is what they think generates growth. And they don't really care that the economic environment that they're ploughing their furrow into is actually really stony, rocky ground that's going to break that furrow and cause chaos.
All right, that's very clear. Thanks for joining us and outlining that so clearly. Phillip Inman from The Guardian and Observer newspapers. Thank you.